Tom Tucci is the head of the U.S. Treasury's trading desk for RBC Capital Markets, and he joins us. So, Tom, we're trying to get creative in saying, are we stalling out here? Are we?
Well, I think there certainly is a downturn. I think a lot of people want to argue that there's a supply chain distribution logjam that's been created out of Japan. But in general here, things have been softening for a couple months now, and I think it's part of the unevenness of this recovery. I think that's what the Fed's been guarding all along, is the fact that this is not an even recovery with a upward trajectory. I think we're in a situation where things are very unbalanced.
Well, last week, the reaction to the recognition of some imbalance there is that treasuries were rallied. Today, we're seeing treasuries sell off a bit. What kind of demand do you expect to see for this week's auction?
Well, I think it's fair, but you need to put it in perspective of where we've come from and where we've broken down from. Remember last December, we announced the payroll tax cut, and 10-year notes were trading right around 295, and we broke down from that level. And if you also remember, at that time, there was a lot of money that was moving out of fixed income, particularly in the municipal bond sector, in favor of equities. So now we've retraced all that, and you're starting to see the same type of conversation take place again. We've seen a significant amount of selling here again at 295. I think a lot of those people have taken some money off the table, and we'll wait for rates to back up to have a better point of entry.
But you do expect to see buyers for the $66 billion in debt coming out this week?
I do. I do think so. It'll probably be more concentrated. The buying will probably be more favorable in the 3-year note and then out to the 10-year note. The 30-year seems to be suffering still from an overhang of the uncertainty surrounding the debt ceiling increase and the budget deficit reduction package that they've been working on.
So, I mean, Tom, how do you strategize around this, particularly as we see at least, the Fed stopping its plan to buy at the end of the month?
Right. Well, I think that's something that's already factored into the market. We've already seen some of these correlated markets unwind. If you remember, starting in August of last year, there was a big rise in equity markets, commodity markets, a lot of the things that the Fed was definitely targeting the equity market at that time, and a lot of these other asset classes performed pretty well. Now what's happening is we're moving to the end of this program, and you're seeing the unwind of that, which actually caused demand for treasuries over the last couple months. So I think there is a balance that's taken place here as people have revised their growth estimates downward, and the bond price yields are more in line with those growth estimates now.
So you don't expect to see any disruption as we get closer and closer to June, the end of June?
Well, not as it relates to QE2. I think that's a very well anticipated event. I think that what we will see is, remember, once QE2 ends, there still is a mortgage reinvestment that's going to be taking place out of the Fed's mortgage portfolio. So there still will be some purchasing, albeit at a lower level. There still will be some purchasing, which will be a gradual decline in what we've seen as far as the full-scale QE2.
Well, we've seen, at least from corporations, some hunger to get their ducks in a row before the end of QE2, or at least to raise some cash ahead of that. What's going to change in terms of investment opportunities?
Well, I think in general, you're probably going to go through the summer months trying to figure out what is the cause of the slowdown here. As I said, people had already started to revise their GDP growth estimates down starting in April, coming to this period of time. You've seen that effect as it related to the employment report that took place on Friday. And the conversations are now about, is this a temporary slowdown? And that's what we're going to try to be figuring out going forward. We have the beige book this week, and we'll have some other domestic indicators that'll be coming out that'll give us a better shape of what's happening here standalone-wise as far as U.S. economy is concerned.
Well, arguably for those who are in the financial markets, exiting the stocks of banks and worried about the exposure balance sheet-wise to mortgages, worried about this another leg down that we're seeing, at least in terms of pricing of houses, there is further reason to be concerned.
True, and I also think that the European situation definitely has to be on the top of the radar screen. That is really proving to be a serious situation as it relates to the banking system in Europe. And I think you can't underestimate the effects of that on the global economy and the banking system as a whole.
All right, Tom, thanks so much.